Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company none other than Tesla. Now I have been pretty reserved in analyzing this company for several reasons, mainly because of the fact that, well, I'm just going to say right now that the analysis I'm going to make isn't going to be taken well by a lot of people, but I'm going to show you guys some proofs as to exactly what I mean. So with that said, let's get started with this analysis. Now guys, before we actually do anything, I would just like to point out a couple of things. First of all, I am a big fan of based Elon Musk. I actually just put out a video a couple days ago, I think it was a couple days ago, when Elon was just like, I'm going to buy Twitter, and he bought Twitter. And I was just like, based Elon bought Twitter. Oh my god, it's awesome. So I'm actually a really big fan of Elon. He's he's the world's richest man, and now he owns Twitter, and he's planning to bring in free speech to the platform, which is amazing, right? I'm also a fan of the Tesla. I think that, you know, electric cars are 100% the future. I'm not saying that I don't understand how people say, oh no, electric cars will never get anywhere. No, I honestly think specifically Teslas on the frontier when it comes to the EV movement, all this stuff. And don't get me wrong, man, their cars are absolute gorgeous. I mean, it is just absolutely amazing. You guys see a little bit of right here. I mean, I don't need to say how cool the Tesla cars look like. In my personal opinion, they're awesome. They are a little bit pricey though, in my personal opinion, but aside from that, the car looks amazing. And if I had the means to, oh baby, I would so buy a Tesla car. It looks so cool. Now, with all of that said, I do have to point out something very important. And that is that the stock is 100% different than the company and the CEO, right? The stock price specifically is based off of what the market is pricing the current company at the moment. And even Warren Buffett says this, right? The Oracle of Omaha. In the short term, the markets are a voting machine, and in the long term, they are a weighing machine. At the current moment, sure, stocks may go up because of hype and maybe people are just really excited for it. However, in the long term, things tend to come back down to their fundamentals. Now, as I have said that, I would just like to point out, before we even get to any numbers, this is Tesla stock, I believe, on the 5 years. You can see it has just been rallying up. I remember when this was worth like 50 bucks or so. By the way, this was post stock split as well. But I remember when Elon put out that tweet saying that at 420 he would take the stock private, and then the stock fell down like 100 or something because the SEC just like was having none of it. And yeah, but after that, man, this stock has just been a monster. So you could see rallying from around like what, $26? Of course, this is post stock split, all the way up to the current price of $870. And by the way, this has actually gone down a significant amount ever since then, because on the 52-week range, guys, this has been all the way up to $1,200, which is just absolutely insane. However, this is where I have to put my foot down. So with that said, let's actually analyze these numbers and see where we can price this company at. Coming over here to the calculator, we got the ticker symbol of TSLA for Tesla. Market cap, guys, of $902 billion. PE, guys, of 117.69. Share price of 870, as we saw. So, as you can see, this is a little bit expensive. And not only that, guys, as I said, the range is on the 52-week high of $1,200. This means that this market cap was even higher. It was close to, I believe, the $1 trillion mark, if not past it, I believe, a couple weeks ago. But knowing that, this PE was probably even higher than 117. So if you think this is expensive on an earnings basis right now, imagine this thing being at 1,200 bucks. That's absolutely really ridiculous. They do not pay a dividend, which means that their 5-year average free cash flow is going into themselves, paying down their debt, making acquisitions, which, let's face it, Tesla may be doing a lot of. Granted, what Elon did with Twitter is not Tesla buying Twitter, it was Elon buying Twitter, so understand that. So with this 5-year average free cash flow, we have some good aspects of it, seeing that since they do not pay a dividend, they can just reinvest it in themselves, and seeing that they're in the positive 5-year average, they might actually be going somewhere with this. Now let's analyze some of the fundamentals, starting with a net income 5 years ago, guys, of negative $2 billion to 1 year ago of $5.5 billion. Guys, that is a massive increase of 381%. Take a look at this. within the 3 years ago, all of these years, negative several millions, if not several billion dollars, right? 2 years ago, they finally went positive when it comes to the net income at $721 million. And then last year, oh my God, from $721 million to $5.5 billion. That is absolutely incredible. However, as it stands, guys, this is technically still the average is around slightly above positive, just because of the fact that last year they did such a huge net income in the positive. But the way that I see this is they still need a lot more years in the positive and positive increasing for me to justify anything good about their net income. Coming over here now to the free cash flow, cash from operations less your capital expenditures. Well, as it stands, 5 years ago, they did negative $4.1 billion to 1 year ago of $3.5 billion. That is an increase of 184% with an average 5 year free cash flow of a positive $561 million. Now, even though this is a positive average 5 year free cash flow, take a look at this, guys. 5 years ago, negative $4.1 billion. 4 years ago, negative $221 million, and 3 years ago is when they finally went positive in their free cash flow at $973 million. Then they went to $2.7 billion and then $3.5 billion. So this is actually looking really, really good, way better than the net income. However, still as it stands, this needs to be increasing within the next 1 or 2 years for me to justify this, because as it stands, this number right here, this negative $4.1 billion is definitely dragging everything down with it. The revenue is pretty much the best metric when it comes to the profits, because from 5 years ago of $11.8 billion to 1 year ago of almost $54 billion, there's an increase of 357.72%. Absolutely amazing. This is essentially what I want to see when it comes to the other two profit methods. Looking now at the total assets minus the total liabilities. Currently, guys, they have $35.4 billion. This means that if they were to liquidate all of their assets, would they be able to cover their liabilities, and by how much? So currently, they would still be left with $35.4 billion, which is not too shabby. And not only that, for their credit as well, they were at positive pretty much throughout the past 5 years as well. Average total assets around $45.5 billion, average total liabilities around $27 billion, average assets minus the average liabilities with around $18.5 billion. And now here is where Tesla just completely gets crushed. All the other metrics that we have seen above are mediocre at least and really, really good at best, right? I mean, these assets minus liabilities are really, really solid, and their revenue is really good, and you know, their income and cash flow could be a little bit better, but it is heading in the right direction. However, their shares outstanding is definitely their killer, and this tells us whether or not the company is diluting you as the investor. The more this number goes up, the faster the rate this number goes up. This means that you are having less ownership of the company. And as you can see right here, 5 years ago of Tesla, 844 million shares to 1 billion shares. That is an increase in the 5 year, guys, of 22.75%. And this is looking at from 1 year ago to today. They increased it almost 0.3%, which is just massive. So as it stands, guys, this is by far the worst metric when it comes to analyzing Tesla, because they are diluting you a whole lot. Now, can they bring this down in the future? Sure. However, notice that they have not been doing that in the slightest. Every single year, they have never even one time brought it down by just a little bit or even kept it the same, right? 844, 863, 905, 960, 1033, and 1036. So the chances of them actually buying back shares, or at least keeping it the same, are probably not likely. And this is where, in my personal opinion, Tesla definitely is a deal breaker, at least for me. And now looking at the cash and equivalents, currently, guys, they have around $17.5 billion in cash and equivalents with an average cash of around $11.3 billion. Okay, so now, guys, let's make some assumptions. Low, median, high, using 3 different factors: revenue growth, projected share buyback, and the required rate of return. By the way, I finally got this calculator to work in regards to Tesla and pretty much any company that has negative income. So yeah, I will be updating the calculator that's available for you guys in order for this to actually work, because if you put in Tesla right now, you will get negative numbers and it really just doesn't work. So I will be updating it. It's a simple change to the formula. It's just adding an absolute value to today's value, and that's about it. And that should fix it. But nonetheless, for the revenue growth, guys, I like to use Seeking Alpha's revenue growth tab and seeing the revenue growth year over year and the revenue growth forward and making an assumption between those two numbers. For the predicted share buyback, I'm going to be using the shares outstanding that we just saw, and the required return, keep it the same, flat at 10%. Now, this company, guys, when it comes to the revenue growth, it is absolutely all over the place. If you actually see it right over here, the revenue growth year over year on Tesla is 73.04%, and the revenue growth forward is projected at 53.46%. Is this likely to happen? Probably not. My job as an investor is to be conservative with my assumptions. The bigger the company is, the harder it is for them to actually grow. And as it stands, Tesla's still growing. Tesla's still young. Don't get me wrong on that one. However, they are still competing, guys, against all of these major other car manufacturers, right? And don't give me this, Tesla is not a car company. Tesla's more than a car company. They make majority of their revenue when it comes to their car sales, okay? So they are a car company. Yes, they have solar. Yes, they have all these other things. However, if the revenue comes majority from cars, they are a car company. End of story. So if we take a look at this, right, they're competing against Ford, which I just did a stock analysis on. They're going against GM, they're going against Toyota, they're going against all of these major car manufacturers, and that's going to be a big hurdle. Sure, is Tesla the best EV when it comes to the field? Sure. However, you are now having to fight against all of these other manufacturers that have mastered, I guess, the art of building cars, right? And switching from gas to now EVs is not going to be that much difficult. And on top of that, these old ones have now two different types of cars. They have gas and diesel power and now EVs as well, meaning that they could actually get a much larger share of the market when it comes to people buying their cars, unlike Tesla that only has EVs, right? So that's just something to take into account. Now, when it comes to the predicted share buyback, guys, they are issuing shares at a massive rate. I mean, we just saw it. So I'm going to continue saying that they will continue to issue shares, even if it's going to get slightly better. So for my lowest assumption, guys, I'm going to say a revenue growth of 15%, predicted share buyback of negative 20%. This means that they're going to continue to issue shares, but instead of negative 22, they're going to issue shares at negative 20 within the next 4 years. This comes out to be a target share price of $24.33. Looking now at the mini assumption, revenue growth of 18%, predicted share buyback of negative 18%. This comes out to be $27.27. And lastly, from my highest assumption, a growth of 21%, predicted share buyback of negative 16%. This is $30.51. Now let us adjust for debt. And the way we do this is we take the cash equivalents and we add the net debt. If they have more debt than cash, this number comes down. If they have more cash than debt, this number comes up. And it does come up by a significant amount. For the lowest assumption, it is now $62.59, median assumption $68.73, and highest assumption $75.48. Now adding a margin of safety, just because you don't want to overpay for something, right? All those people that bought Tesla at the $1,200 mark are probably really scared right now, since they just went down, what, $400, which is just crazy, right? So you want to add a margin of safety, and in doing that, with a margin of safety of 5, 10, and 15%, you would like to buy between $53.20 to $59.46. For my media assumption, it is $58.42 to $65.30, and for my highest assumption, it is $64.15 to $71.70. Now guys, as it stands, the current share price is $870.76, and it has gone down from the high of $1,200. So yeah, this is where people usually begin to say, oh, these numbers are crazy, you don't understand Tesla, you don't understand growth. Okay, what is the first thing of my assumptions right here? Growth, right? Revenue growth assumption. It literally is that. The first thing that I usually see when it comes to a company is how much are they going to grow? The problem is that you can 100% overpay for growth. And I'm going to bring you guys some examples. So let's actually take a look at one of my favorite stocks out there, and that is Intel Corporation. Intel Corporation was one of those companies that prior to the dot-com bubble, look at this, it is just skyrocketing all the way up to $75, and people, I'm pretty sure at the time, they were like, oh my god, the internet, it's going to be amazing, it's going to change the world. And then dot-com happened, and 22 years later, they have still yet to reach the high of $75.69 roughly. Let's take a look at another one. Cisco, another company that I've done an analysis, as you can see right here. Cisco, current price around $49. What do we see? The exact same thing as Intel. It is starting to go up, and then because of the dot-com, because the internet was taking place, they went all the way up to around something similar to $77.86, and then it crashed, and 22 years later it is still never reached its high of $77. So here are a couple companies that pretty much just show that you can 100% overpay for growth. What was the biggest technology in the 21st century that changed the world? Probably the internet, right? Okay then, explain to me why Cisco and Intel, specifically Intel's cash flow has increased 4 times within the past like 20 years, and yet they have still never reached this high share price. So my point is that you can 100% overpay for growth. And it's not just these companies, guys. Let me bring you a couple of new ones right now. We got over here, this is Peloton, right? Peloton, same exact situation. Look at this. It is just a rise up, right? It is just a massive rise up to $150 or so, and then boom, it just crashed. Here's another one, Palantir, another rise up to around $35, and now it is at $10.40. So a couple of examples as to how you can 100% overpay for growth. And in fact, in 2020, Elon Musk himself said Tesla stock price is too high in my opinion. So understanding all of these past companies, Intel, Cisco, and now these current companies, Peloton and Palantir, that have gone through a very similar motion when it comes to their share price, my whole point is that you do not want to overpay for growth. I mean, currently, Tesla's share price is $870. Now, a lot of you might say, oh, that's because Elon sold. Okay, that's beside the point though. The stock fell. Right? The stock fell. If you bought Tesla at the high of $1,200 bucks or so, thinking that was going to continue to go up, well, now you are down $400, roughly $400 per share, right? So that's essentially what I'm trying to avoid here. And the fact that these numbers are this low is because of the fact that you do not want to overpay for growth. Do they have a lot of potential in the future? Sure, of course they have, right? But the point is, we're not trying to analyze the possibility of something happen. We're trying to analyze the probability of something happen. What is the probability of Tesla actually being worth $870? Let's actually figure this out, right? Let's take the highest assumption and let's see what number on revenue growth and predicted share buyback this has to be in order to justify the $870 mark. And what we can see right here, guys, is after making a lot of assumptions, Tesla would definitely have to grow at 120% in regards to their revenue within the next 4 years and start buying back shares at 20% to justify a rough price of $889, which is fairly close to this current share price, to essentially justify it today. Yeah, this to me is not probable in the slightest because they have been issuing shares at around 22%, so this isn't likely. Now, as I always say, guys, in every single video, this is just my assumptions. Get this calculator and you should make your own assumptions. I am going to fix this so that way you guys can use Tesla and figure out which assumptions you agree with the most. But my point as an investor is to essentially make reasonable conservative assumptions so that way you do not overpay for something. Because in my personal opinion, 120% revenue growth within the next 4 years and a 20% share buyback is just massive, right? It's absolutely insane. And I just don't think this is probable. But then again, these are just my assumptions, guys. This is not financial advice. Get this calculator. It's available for anybody. I also have the book value calculator as well. Make your own assumptions and you should see where your Tesla share price should actually be at. I'm not telling you guys what to buy. I'm not telling you guys that these are the exact numbers. I'm showing you guys the raw numbers for the net income, cash flow, all that stuff that's available for public consumption. And I'm showing you guys where I would put this company at. If you disagree with me, then by all means, get this calculator, get the book value calculator and the dividend tracker. It's all for free. All I'm asking for in return, guys, is like, subscribe, comment, and help me grow my channel. All in all, guys, when it comes to Tesla, I like Elon Musk. I think he's a genius. I love the trolley side of him. It's absolutely amazing. The fact that he bought Twitter and is just making all these people cry is just absolutely hilarious to me. I love Tesla's cars, right? I think EV is going to be the next thing. However, when it comes to their share price, guys, this to me is just very, very expensive. And in my personal opinion, you know, this is not worth the $870. The valuations are just way too overpriced, and even Elon thinks so as well. That pretty much does it for this video. As I said, like to like, comment, subscribe. Have these calculators for free. You can follow me on my new tech sites at BitChute, Odyssey, and Rumble. Links in the description below. I also have a Let's Play channel. Also, the link is in the description. So with that said, peace out, and I will see you all in the next stock analysis video.